Okay, I'll just check that you guys can hear all right. How's the sound over here? It's okay? Okay, that's a nod. Yep. You guys all right for sound up there? You want a bit more? How's that? Is that better? Good. And you guys okay for sound? Right. Let's check the time. Okay, it's gone 12, so we'll make a start. Okay, so today we start our final topic or final pair of topics, the investment banks and their investment banking services, and then also the venture capital. And the two things are both distinct but also reasonably closely related in what they actually do. So this is an outline of what we'll do. We'll talk about the role of investment banks first, then talk about where they came from in terms of their history, and then investment banking in Australia and the services that they provide. And then the last part will be the venture capital, which we'll come to tomorrow. So we'll probably not quite get through all of the investment banking today. We'll finish that tomorrow and then finish off with venture capital. So, as we've said before, because we've, as we've gone through the course, even beginning back in the section on the Reserve Bank, we did begin to mention investment banks and what they do. And what they are is, in terms of their function, is that they're the most important part of the direct financing, and so bringing things through to the primary market is where they do most of their work. So what they're there to do is to help both firms and governments to access the direct markets. So it's not intermediated finance, it's just direct markets, and so they're key job is to bring new securities to markets. Now, one of the other functions they perform down here is that after they've arranged for the selling of, say, a security, say it was shares or something like that, they then transfer those to a secondary market of some sort, typically an exchange. But in the case that there is not an exchange type of market, what they often do is will retain some of the shares or the bonds or whatever they are themselves, and then they become the market maker and they act as a dealer in those types of market. So they can't act as a broker, and often you'll find an investment bank will have a share broking arm, like, for example, Macquarie Bank, which is a large investment bank in Australia, has a branch called Macquarie Private Wealth, which does its stockbroking for its clients. So they do have activity in the secondary market, but their key role is in this primary market of bringing new securities through the market. So there's several terms. There's the investment bank, commercial bank, universal bank. How do these things differ? When we talk about an investment bank, universal bank, commercial bank, how are they different? Yeah, go ahead.
I think universal bank is the combination of commercial bank and
Yeah, so in terms of those three, a universal bank essentially takes the two roles, the investment bank and the commercial bank, and you have one company doing both. Okay, and we've met commercial banks before, so what's an investment bank? Ooh, all very quiet. One thing about the name bank, often people, when they strike what an investment bank and they begin to understand what it doesn't behave like any bank that they know. And the other thing about them is that in both Australia and New Zealand, the word bank is legally privileged, and so you have to be a registered bank to use that name in your, in the name of your company. Often, an investment bank doesn't have the word bank in its name. For example, Macquarie would have Macquarie Bank if it was a licensed bank. If it was not a licensed bank, then it would have to have some other name. So the investment banks, well, the commercial banks, when we've talked about before, one of the things that really is very obvious about them is that they are in this traditional intermediated financing. So they take deposits from small depositors, they put them together, and they make direct loans to their clients as well. And so they're commercial banks working mainly in the indirect market, whereas the investment banks are working primarily in the direct market. So they're to get money raised for companies, and they do that by helping them to issue their securities. And we said that about the Universal Bank. Most of the world, with apart from the U.S. and Japan, a bank can do both operations. They can act like a commercial bank, they can act like an investment bank within one, and those are called universal banks. So where do they come from? One of the sort of accidents of history, which is, if you look back into history, it's very sad that we have these attitudes. But they actually come from Europe. And the reason they come from Europe is that through the Middle Ages and later as Europe developed, there was this prejudice against the Jewish people. And Jewish people were not allowed to hold property of any sort. And so what happened was essentially it forced them into other areas of business and work, which did not require property. And a lot of them ended up in finance in various ways. And so they actually formed these initial investment houses, which they did not own property, but they were engaged in finance. And then the investment bank itself sort of really took off when they actually branched over into the U.S. And of course, what happened was there were some specific developments which required a new type of financial institution that didn't really exist prior to that. And the big one of the drivers, the two main industries that were big drivers, the railroads and the steel. And both of them were enormously expensive. If you think about a railroad, say a transcontinental railroad in the United States, it's about 5,000 kilometers from one coast to the other. And if you're going to put a railroad across there, it's enormously expensive laying that track, building all the necessary bridges and other infrastructure, and building the rolling stock to go on these railways and get the whole thing working. Steel was also an extremely expensive business to get started. And so the need for capital for these industries is what drove the beginning and the early development of the investment banks. So what you needed is, when you think about it, particularly you think about the issue of the raising capital for a railway, often there's potential investors. Most of them will probably be on the east coast of the United States, and yet they were laying this transcontinental railway. And so you as an investor couldn't sort of just pop out and have a look at it and see what you thought. And what you really needed was someone that you could trust that would give you fair valuation on the securities being brought to market. And essentially that is where the investment banks started, as the intermediary that could be trusted to put a fair value on the securities that were being brought to market. And so that's where a lot of them got started, and a number of the major banks that we have today, major investment banks, actually got their start in this particular period. And if you're good with names, you can tell Jewish names from other names, because they were originally branches from these Jewish investment houses in Europe. A number of the very largest investment banks in the world, have a Jewish name to them. But anyway, once they got going, there's a lot of, if you think about what they do, they actually have a lot of financial expertise inside them, and they essentially started to offer any sort of service that they could earn a good return in terms of fee. The underwriting was their main one, but these days financial consulting is fairly important, determining things like capital structure and that sort of stuff. They themselves are engaged in security trading, both as dealers and often sometimes, on their own account, trading on their own account. Private placements, again, that's part of raising capital. And another big thing for them is these mergers and acquisitions. So they're helping companies that either two companies agree to come together and they'll get involved in that merging process, or one company buys another, that's an acquisition, and they'll get involved in the acquisition part of it as well. Now, it's not without risk. They do actually make a lot of money. And sort of give you some indication of just how much money these things made. How many people have heard J.P. Morgan? Know of J.P. Morgan? Yeah, a reasonable number. In the 1920s, he built what was then, and for many, many, many years afterwards, the world's largest private yacht. It was 328 feet long. That's longer than a football field. It displaced, I think, 6,000 tons, and it had a 2,200 horsepower engine on it that putted along, so it could chug along. And he paid for that. Think of a big thing. He paid for it with a half a year's worth of take-home pay. Yeah, I know, he's a rich dude. Rich dude. Yep, 6 months worth of take-home pay, pay for a nice boat. Not your little fizz boat or your kayak. I could afford a kayak, great big monstrous boat. So there a lot of money to be made, and so what happened in that time, again, this is one of the significant developments at the time, is that the commercial banks, they got really envious. They saw this money being made, and they pressured the regulators through that big boom period to be allowed to become investment bankers. And 1930, which is the start of the Big Depression, they actually were granted full investment bank services. And unfortunately, that was really bad timing, and it didn't last. And what happened was, only a few years later, like 1933, this Glass-Steagall Act was put in place, which actually split, again, the commercial banks from the investment banks. And we're allowed to do a little bit of underwriting, but only in the lowest risk areas. And that separation of the commercial bank from the investment bank became a feature of the United States financial system well into the 1990s. I think it was 1999 that thing was actually repealed. And a lot of people to this day can consider one of the seeds of the financial crisis was the repealing of this particular piece of legislation and allowing commercial banks and investment banks come back together and engage in much higher risk activities, which then came back to bite them. But anyway, most of the world, including New Zealand, we have these universal banks. If you look at what happens in terms of time, there was this period of deregulation in the 1980s, and what tended to happen at that time was that we actually saw the development of investment banking as a separate type of institution. So instead of having a commercial bank did both, you would have an investment bank as a specialist institution that did that, and that started to come about in the 1980s. Initially, it wasn't local, so the offshore investment banks turned up and opened branches here, but as time went on, the local banks also developed investment bank services. So there's no sort of stable ground in this. The commercial banks, as they saw the profitable opportunities and deregulation allowed them to take hold of those, they actually went out and opened up investment banking arms of their business. But the other thing that tended to happen on the other side is that sometimes investment banks, once they were there, would apply for a banking license, and then they would sort of transform themselves into a universal bank and have deposits and so on. So there's sort of this tension between both of them, and it never really settles down to an equilibrium, I guess. Okay, any question on that point, up to that point, or until we go on? Okay, moving along. There are a surprising large number of these things out there. Like this is, I haven't been able to get any updated data on this, but this is stuff from 2010. They had 38 what were called money market corporations, and they're called money market corporations rather than investment banks simply because the word bank is legally privileged. And then they had another, at that time, 413 finance companies that offered some types of investment banking services. So if you add those up, we're over 450 organizations that do some type of investment banking. But like many of the things we've seen in the financial system is that there's actually a very high concentration in the top ones. And, if you think they're 12 dominate out of the 450, and of those, the top 6 have about 75% of the market. So it is like many of the other things. There's a few large ones and lots of little tiny ones doing this. Now, in terms of the assets that they have, they've grown quite substantially. Now, the thing that these numbers are in the book, starting at 23 billion in 85, going up to 68 billion in 2010. But there was this peak in 2008 of $120 billion in assets. So they've grown strongly over time. Of course, after the financial crisis, we saw the value of their assets decline quite sharply. But they have experienced significant growth, and they're still quite strong today. So there's probably not much to see in that one. I was going to, the total assets here, in here between 2005 and 2010 was this peak of about 120 billion total. But when you look at them, it's spread across a lot of other stuff. When you think about a commercial bank, its assets are strongly concentrated in its loans and leases that it makes, primarily in its loans. The investment bank, their assets are spread across quite a number of different asset classes. Oops. So because they're not taking deposits from small investors, that changes the way that the regulators look at it. And so there's various ways that an investment bank can be structured. If it's structured as an authorized deposit-taking institution, essentially they have a banking license, and then in both cases, whether local or foreign, they are under APRA, but also because they're issuing security, the Australia Security Investment Commission gets involved. Now, if you're a money market corporation, now this is like your pure investment bank, then APRA is not involved. So there's no prudential regulation around these things, but you simply have to comply with the securities investment law that is relevant. And then there's things like things we call securities companies, which are engaged in stockbroking and that sort of stuff, and they have self-regulation from the stock exchange itself, but also in terms of a government regulator, they have the Securities Investment Commission as their regulator. Okay, any question on that before we move on? Okay. So they got a wide range of services, but the big one is the issuing of new securities into the market. And when you think about why people or corporations would like to access the markets, they want to raise capital for their investment, and investment banks are involved both in raising capital domestically, and if necessary, they'll help you to raise capital on international markets. Often the major ones will have branches overseas, or be a local branch of an overseas investment company, investment bank, and so they can actually help you to raise overseas. So common one is issue of shares or bonds. If it's the very first time, it's called an initial public offering, the IPO. If you're issuing more of the same, it's often called a seasoned offering. So I've actually got some updated data here on this one, I think. Where did my updated data go? Yeah, so this is the IPO market. So here we go. This is an Australian IPO market. So unfortunately, this didn't photocopy very well. There are other bars in here, but let me grab a pen here. So this lists the IPOs both by sector, by number, and by the value that they took in. And so the biggest one in terms of value is what's they got labeled here as TMT. That stands for Technology, Media, and Telecommunications. So by number, this was 2015. By number, they were only 27% of all IPOs, but they took almost half of the money, and that was raised through an IPO. So the big one, Technology, Media, and Telecommunications. Financial services was second largest, which in some ways a little bit surprising, but about 20% by number and about 18% by value. And then most of the rest of the stuff is quite small. Like, for example, this one here is property and construction, only 3% by number, but again, quite a chunky 9% by value. Retail, about 10%. What's that? Infrastructure and logistics, 7% by number. Healthcare, 13% by number, but only 1% by the amount of money that was raised. And then consumer services, energy and resources, commercial services, and agriculture. So the market has been relatively active in recent times, and we do tend to see this as when the stock markets are strongly rising, you tend to get more IPOs coming to market than when the market is weak. So this is sort of an indication of where the money has been going in the IPOs. And of course, the dominant sector there in terms of value is the technology sector. Any question on that before we move on? Okay. So in terms of getting business, now we've talked a little bit about this before. There's essentially two ways that they may get business. The first is that they may go out and compete for business. And so if a potential issuer wants to issue some shares or bonds or something, they can invite a number of investment banks to bid for that business. And it's fair to say that the largest investment banks, the ones with the highest reputation, tend not to respond to that type of an invitation. So if you want a competitive bid, a lot of them just won't touch that sort of stuff. Now, in some places in the world, some types of firms, and these tend to be things like utilities and other infrastructure companies, which are strongly regulated, they are often required by law to use a competitive bid if they want to raise more money. But, as I said, most of the big banks don't do this. So the other way you can do it is you can go directly to a bank and you can negotiate directly with them about having your securities issued. So you talk to them directly and you customize a deal with them. And the reason that the big banks only do these ones is simply these are more profitable for them. Now, if they don't do it right, and they get the pricing wrong, they can harm their own reputation. And so there's if they've harmed their reputation, it can be harmed on both sides in terms of the private investor thinking they didn't price this right and my shares tanked, or from the issuer's point of view, they underpriced something and they didn't get as much money off the IPO or whatever it was as they would like, and so the reputation of the bank is quite important. Now, actually, pricing an IPO is pretty hard, and here's an indication of just how hard that actually is. So again, this is Australian data, and so this was performance of fairly large listings, so things that took more than 75 million in, and this is year to date up to 21 August 2015. And something like this one here, I'm not even sure what this company does, but anyway, it's called Superloop, and it had 120% gain. So, and then the next one here, Future Fiber, a 62% gain, Martin Aircraft, 50% gain. When you look at those sorts of gains after initial listing, there's a clear indication there that something went wrong with the pricing of this stuff, that these things were strongly undervalued, and there was more value there than the seller got. And so this is good for the buyer, but it's bad for the seller. And for things like that, amongst issuers, if you see something like that, you think, what investment bank brought that to market? And then you think, well, I'll avoid them because they didn't do a very good job. On the other end, the losses weren't anywhere near as big, but you do see some reasonably big drops down here. MYOB, accounting software company there, lost 13.4% of their value after listing. So again, that tends to, that's not anywhere like 120%. But again, if you were looking at that as an investor, from the investment point of view, you don't think, who brought MYOB to market? Maybe they didn't do a very good job. Maybe I should avoid their issues in the future. So it is a difficult job to do, valuing things, particularly valuing things that have not been on the market before. It's a tough job, and people accept that there's a little bit of wiggle room in terms of things, but things like 120% indicate that something went pretty wrong with their pricing on them. Okay. Any question on that before we look at this question? Okay, so let's say you're going to bring a new security to market, and it's going to be underwritten. What are the steps that we have to go through to get this thing onto our market? Ooh. Oh, very quiet. Poor guys. Oh, very quiet. Okay, so roll over. First up is what's called origination, and basically, there's various types of securities like shares, preference shares, bonds, money market securities, and so on. You have to figure out when the company comes in to raise money, often the key thing is they want to raise money, is what is the best option for them in terms of the range of things that you could issue. And then once they've figured on which particular type, then you have to go and set up something that's quite specific to the company. Sometimes it's quite clear, if for example, we talk about venture capitalists, they want to sell down their investment. Often you're definitely going to have to do an IPO of shares at that point. But many companies, they're really just asking them to help them raise funds, and then so you got to make a decision. Like, for example, do we issue shares? Do we issue bonds? If the answer is bonds, then you got to figure out how long you need this money for, and that sort of stuff. So you got to design the security, and that part of it is called the origination. Now, there is this claim that they're systematically underpriced by about 15%, which has given rise to this rather common practice of what we call stagging, and basically people buy them on the float at the IPO, and as soon as it's listed on day one, they sell. Because often there's quite a little sharp uptick on day one in terms of price, and some people buy the IPO with the intention of selling it on day one. And the argument as to why this happens, in terms of why, is the investment banks actually do take quite high risks by bringing an IPO to market, and by underpricing them, they actually protect themselves against a loss. In case if they were fairly priced, then the chances that they were left holding shares that they would like to have sold is higher than if they underprice it. And so there is said to be this incentive for investment banks to systematically underprice the security to make sure that they sell them. Of course, that's not good for the issuer, and it leads to the staggers buying them with no intention of holding them. So once you've done your origination, you made this decision about what you're going to do. You've got to make a decision between underwriting and a best efforts offer. So the underwriting, the investment bank actually buys all the securities off the issuer. So they decide on a price, and then they have a fixed price to the issuer, and then they turn around and sell those at a higher price, they hope, to the general public. And the difference between what they get when they sell it on to what they pay, that's their spread, and that's how they make their money. And the quicker they can do this, the quicker they can sell them, reduce their price risk there. But because they actually own them, there's a point of time, when they actually own them, between when they've agreed on the price with the issuer and actually sold them, that they have the exposure to the price risk. So in the underwritten offer, because the bank buys them, then the risk of the price going wrong is borne by the investment bank. It's not borne by the issuer. And that's where they get their profit. Now, the other one is what we call a best efforts offer. And in this particular case, the bank doesn't buy the securities from them. Okay? It doesn't guarantee a price. It simply takes on essentially almost like a role of a broker. They do the best they can, that's why I call it best efforts offer, to place the securities at the best price they can get, but they don't actually put their money into it themselves. And essentially how they get paid in this case is by the value of the shares or other security that has been issued. So they're essentially earning a broker's fee. Now, if you think about the two of them, if you think about something that's coming to market as an underwritten offer versus something that's coming to market as a best efforts offer, if you were an investor and you're looking at several different prospectus, and you think, and one says underwritten by blah, and the other one is not underwritten but being brought to market by an investment bank, what would that tell you about the quality of the investment being offered? Oh, yeah, go ahead. Yeah, okay, so the best efforts offers tends to be a sign of low quality. Basically what you see there is the investment bank is not willing to risk its own capital in bringing this thing to market, and so it's a sign that either the quality is not high or the risk is not high or some combination of both. And they're not very often that you see a best efforts offer, but they do happen. And this one's getting a bit old now. This little company, which still exists, the New Zealand Wind Farms, they had a rights issue, and it was just the investment bank that carried out the rights issue on their behalf did not underwrite the issue, and it was very clear that they thought that was just too risky to put their money into this. So that is a sign for you as an investor that you can take note of. If it's underwritten, hopefully that means it's a much better investment than something that's being offered to you under a best efforts offer. Okay, any questions on that before we go to the next? Yeah, go ahead.
Just wondering that, as you mentioned before, that the APRA, they restrict the institutions for themselves a bank.
Yeah.
Especially like for the investment bank, you said there was 4 types under different categories.
Yeah.
For some, some investment bank, they do not, they are not authorized the deposit taking. So why they still call themselves a bank?
Well, I mean, that's one of the things is that in terms of, when we're talking about these things as an institution, we refer to them as investment banks. Now, in Australia and New Zealand, the name bank is legally privileged. So something that is what the rest of the world would consider to be an investment bank, say a pure investment bank, it would not have bank in its name here or in Australia. It would not have the name bank. And when we looked at that list, like you see, like in there, like they said, money market corporations, okay, that's a name that's basically there because you cannot say that these things are investment banks, even though in the rest of the world, a money market corporation is just, you look at that, think, well, that's an investment bank, okay? And they're identical to investment banks elsewhere, but because the name bank cannot be used unless you are a registered bank, that's why they have these alternative names here.
So in New Zealand, if you say investment bank, what category you refer to? Do you refer to universal bank? In New Zealand, Australia?
Like one of the things that they, like for example, some of the stockbrokers, like major ones like Craig's Investment Partners, that's their name, Craig's Investment Partners, they actually discuss in their stuff about their investment banking services, okay? But you will never see them called Craig's Investment Bank, and they'll never put Craig's Investment Bank or anything like that because they're not a registered bank. And so it is, I mean, this is where it's kind of funny in one sense, is that the name bank is legally privileged, but banking is not. Okay, so Craig's Investment Partner can talk about their investment banking services, but as long as they don't say that they're a bank, it's okay. Okay, any other questions? Right, okay. Okay, why are these issuing these securities? Why is it risky for an investment bank? Yeah, go ahead.
Especially for pricing, that if you price underpriced, the issuer won't get enough money. If you overprice the investment bank, can lose money.
Okay. So there's a combination of two things. One is, to think if it's overpriced or underpriced, quite seriously, then there's the issue of reputation. Okay. So that if they damage their reputation, then the chance of getting more business goes down. The other thing about that is that, particularly in the underwritten offer, if they get the pricing wrong, then they stand to actually lose money on this stuff. Yeah. And the other thing about them is because they don't have these prudential regulations, they're actually very, very thinly capitalized. And so it doesn't take a lot of losses for them to eat up a lot of their little capital that they do have. In fact, the way it actually works is because it's relatively, once it gets into the stage where they're going to, actually, they've agreed on the price and they're going to put it in the market, there's a relatively short period of time there where between when they've agreed on the buying price and they're selling it, is they'll often go out and raise the money with a money market issue of commercial paper to finance it, because they don't have the money themselves to do this. So if they're going to say, bring $100 million worth of shares to market, often they don't have $100 million just laying around. And so what they'll do is they'll issue money market securities to get that money in to finance the IPO. But of course, if you then get to the end and you haven't got enough money in, you've got that additional money that you've lost. It's got to come out of your capital. They're very thinly capitalized, and it doesn't take a huge amount of losses to put these things into serious trouble. Okay. Any question on that before we go to about the secondary markets? Okay. So what roles do they play in the secondary markets? Oh, all very quiet again. Gone quiet. Right. So we'll just roll over here. So said that. So there's essentially two things they can do in terms of the secondary market. A number of the investment banks will have something like a share broking arm. And like, for example, I just said about Craig's Investment Partners. Most people tend to think of them as a share broker, but they also are investment bankers as well. And so it's not uncommon to see investment banks with a share broking arm. Like, for example, if you think of Macquarie, a major investment bank in Australia, it has a piece of it which is called Macquarie Private Wealth. And the Macquarie Private Wealth is, if you want to join up with them and buy and sell your shares through them, that's what they do. So they're definitely dealing as a brokerage function. But if the type of security that's being issued is not going to be listed on a secondary market in terms of an exchange, often what they'll do is they'll actually act as the dealer. So they can have two roles. Some of them, they can act as a broker, and some of them, depending on the structure of the market, they can act as a dealer. Some of the other things they can do is if people like leverage, they'll often actually provide you facilities to borrow money. And they'll do other things like hang on to your securities for you, for which they'll charge you a fee, of course, and provide credit to the customers who want to actually leverage up their investment. Now, this is a bit of a digression, but so this is still part of their work. In terms of the services they provide, often because they're working in these markets, many of them do have some sort of share broking arm. And so when looking at their share broking services, there's various types. There's things we call full services brokerage, and they often are the ones that charge the highest fees, but what they do is essentially provide you with all the services that are necessary to invest in these markets. So often, like if you're investing, you don't actually want to hold your securities under your own name. It's kind of surprising how many people do that. But anyway, often they will be able to keep the securities for you. Obviously, if you're ringing your broker up and you want to trade, they'll do that for you. Now, this one here, this is often investment and research and advice. Particularly the research is actually quite expensive to do. It's quite expensive to carry out. And often you cannot get hold of this stuff unless you're a fee-paying client. Now, the thing about this investment research is that it's one of those really weird things where it sounds like it ought to be a good thing, but in actual fact, the value to you as a customer is actually pretty limited. And the reason is, if you think about how an efficient market is supposed to work, okay, as new information comes to the market, you have to price that information, and the process of pricing that information is quite difficult. So what they tend to do in terms of their investment research is that they tend to research companies where they're going to generate a lot of trades because they want to earn their money back. And so what you see in terms of this type of stuff is often the research is concentrated on the most traded stocks. And so they might have advice around things like Fletcher Building, but when you went down into some micro caps, there's no investment research there. And one of the guys I had, I think about 4 years ago, come and give the guest lecture. He actually flew down from Auckland, very kind man. And he said that where they made money, above average returns, was what they would look at is which stocks are covered, by these investment brokers, and then they sort of whittled it down to a bunch of stocks that had virtually no coverage at all. And they said if they did that, threw out all the ones that were covered by the major banks and share brokers, and just concentrated on the ones that were not covered by normal research, they could make above average returns there. And so in one sense, the investment research, if they're doing that, it means that the stock that they're going to invest in probably fairly valued. That means you're probably going to earn average returns. So although often the stuff is very comprehensive and quite detailed, very interesting to read at times, often its actual value to is quite limited. And then the other things they do there, margin accounts, cash management service, that sort of stuff, it's the money market stuff, they'll do that. They have competition, so if you go in with a full services brokerage, you'll often pay the highest fees in terms of your trades. But if you're confident yourself, you can make your own decisions and you don't need their help. There's these internet ones, discount brokers. Often all they offer is an execution only. In fact, often you just put it in online and they'll execute whatever you say, but they don't offer advice. Okay, any question on that before we go on to private placements? Okay. So, back to me before, what's a private placement? Yeah, go ahead.
I think it's only a few large corporations just participating about.
Okay, so on the buying side of the securities, there's like a limited number of large corporations that take big chunks. Okay. Yep, that's definitely one thing that goes on. Yep. Okay, so in a public offering, like you may have thousands upon thousands of people investing in the thing. Okay, and because it's public, there's all sorts of legal requirements around the prospectus and that sort of stuff. But with a private one, because you're dealing with large institutional, sophisticated investors, a lot of that requirement goes away, and it's up to the investors to make that due diligence themselves. So yeah, that's what it is. You're making a placement with a small number of large investors, like life insurance companies. Probably not much more to say about different from an underwritten deal. Underwritten ones, is when you're going out into the public market and you spend, selling to all the, general public. In terms of their, in terms of the fees. They tend to make lower fees on this, and they don't actually take the price risk on them. But one of the things that, and I think we've said this before, that if you need to raise funds quickly as some sort of company, then the private placement is often the fastest way to raise money if you need it quickly. Right, any question on that before we go to the next one? Yep, go ahead.
Just for this private placement.
Yeah.
It's the, for example, if I have like if I'm trying to issue like a share,
Yeah.
and I have a private placement, but if the private corporates or people involved, they didn't buy more, so what about the rest? Is the investment bank still underwrite the rest of us?
Oh, in the private placement, the investment bank does not normally underwrite them. Okay, so what you do is you hire the investment bank. It's sort of like undertaking a best efforts offer, and what they're using their expertise to do is that they locate investors for you, and then they help you to place your securities with those investors. And so they make their money basically on a volume sold basis, but they don't actually underwrite them. And so it's always a possibility that these large investors, like life insurance companies, is quite a common one they go to, is they might say, we don't like this and we won't buy it. And so, the risk, the price risk lies with the issuer. It doesn't lie with the investment bank in this type of issuing of shares or bonds.
So in that case, that if the shares not appropriate, the new shares not appropriate, it's on the other hand, it's not the quickest way to raise funds.
Well, what you have to do is you have to price it in such a way that it is attractive. Okay, and typically, if they go for a private placement, usually there is no problem with actually doing a private placement. If there's any sticking point at all, you simply have to lower the price to get people to invest. I mean, it's a trade-off between risk versus reward. If that doesn't stack up, then you got to increase the reward, and the only way to do that for you as an issuer is to push the price down. And typically, it doesn't. There's not an issue in terms of actually issuing them. It's simply a question on what price will it go at. Okay, any other questions? Oh, hello. Right. Yes. You didn't send me an email. Okay. Okay. I did have a request from the woman who just walked in that we would stop at 1:45 because they need this room for a test, but she didn't send me her email to say that she was going to. So we'll stop at this point, and can you quickly as possible vacate the room so that they can set up for the test?